You're on? At 10:29, knock on the mic and you can talk. So at 10:29, knock on the mic, give them about a minute, and talk loud. I mean, even though there's a mic, initially at least you talk.
Hi all, we would like to invite you to the 6th annual conference of the Latin American Business Association this Friday, March 6th at Kimmel Center.
We have a terrific lineup of speakers. We have 4 keynote speakers: Alejandro Werner from the IMF, Walter Bailey, who is the CEO of the largest bank in Peru, Alexandre Hohagen, who's the Vice President for Facebook Latin America, and Hernan Mendez, who is the CEO of Procafecol, the company who managed the Juan Valdez coffee brand.
We also have 5 different panels, and it's an executive panel, a financial outlook panel, a politics panel, and then an entrepreneurship and a private equity panel. So we hope you all can come.
Thank you.
Now I thought Laba just gave parties, but I guess they have speakers too. So, but they do give the best parties in the school, I've heard. Couple of announcements before we begin. I mean, things that you already should have seen in your calendar, but my guess is you're avoiding looking at it. The first is your first quiz is a week from today. Don't act surprised. I mean, you've known this right from the beginning. You've just chosen to put it on the back burner. It is in the first 30 minutes of class, and we will also have 170 for the time of the quiz, because it's just too crowded in this room for all of you to be in here with your elbows going. And so I will send out an email by Wednesday giving you seating arrangements. So please stick with those, because otherwise we'll end up with too many people in 170. So there will be an extra room. There will be about 100, probably 110 people who will leave this room, which will give you more than enough space to spread out. It is open book, open notes, open iPad. Okay? But I am going to draw on the honor system, because once you open an iPad, and this has always been my worry, is you just have an opening to the whole world, right? So in a sense, I will have to draw on the honor code to make sure that if you're using your iPad, you're using it only for the reason I have to open the iPad is some of you did not print off your lecture notes. It is on the iPad. I understand it. Your notes are in the iPad. But use it specifically for that purpose. So don't open up, your internet and check out other people and what they're doing. That's not the purpose of the exercise. There will be class after the quiz. Let me repeat that again. The quiz is the first 30 minutes. Do not leave after the 30 minutes. Okay? So there will be class. We'll usually start about 5 minutes after the quiz ends because it requires time for people to get back here. So we will have about 45 minutes of lecture after the class. Finally, there will be a review session for the quiz on Friday, which does not make me happy because I'd prefer to have the review session the day before the quiz, but that's a Sunday. I'm not coming in on Sunday, so you can come and hang out if you want. So it will be Friday, which will be a little early for some of you because if you haven't studied yet, review is kind of it's back-ended. But I will do a review session from 12 to 1 in 260. Okay? I know that all of you will not be able to make it. You have other stuff. It's a Friday. It's midday. I don't know what you have. But the session will be webcast, so you'll be able to watch the webcast by later that day. So it'll be just like the classes. So there'll be a review session. Finally, I also sent you the links already, but I'll send them out again of every quiz one I've ever given in this class. So you cannot complain that you did not have enough problems to try out because you will have more than enough. Okay? My suggestion is do not put off preparing for the quiz till the day before the quiz. It's just too much stuff. It's not difficult, but it just piles on top of stuff. So if you can spread it out a little bit, it will help. So start, and there will also be a TA review session this Wednesday like there's been for the last couple of weeks. So if you're feeling unprepared or you just don't know whether you're prepared, the best way to find out is pick up an old quiz, try working it out. If you're completely and totally lost, you are not prepared. Okay? So that's kind of an indicator. That's because these are actual quizzes that people took. Some are more difficult, some are easier. And as I haven't quite finished writing the quiz for next week, but will it look like past quizzes? Obviously. I'm writing all these quizzes. Will it be like a past quiz? Of course not. Do I look stupid? I mean, it's an open book, open notes. If I gave you the same quiz from a previous year, you'll just repeat everything we did. So there'll be one twist in every problem that you haven't seen before, or a combination of things that you might not have seen before. But if you work through the past quizzes, there should be no surprises. Okay? Second, I know, is anybody not picked a company yet? You're not going to admit to it right now. So what I'm going to actually do is open a Google shared spreadsheet so that you can just, this is not mandatory. If you don't want to enter it, that's fine. But it'll be nice to see what companies you've picked. And you don't have to enter it in a group format. I'll just put it alphabetically, just put in the company. I just want to know what you're doing. And don't freak out if you see somebody else doing the company you're doing. There'll be some companies that 6 groups or 7 groups will be doing in this class. And it doesn't bother me in the least because none of your numbers are going to match up. That's the nature of corporate finance. You can look at the same numbers and make different judgments. So when we pull things together, it'll be interesting to see why you made different judgments for the same company. So just enter your company, nothing more than that. And I'll I might use that as a vehicle for bringing in companies to talk about in class. Last thing, if you get a chance, watch a webcast on beta, on reading a beta page, and use in fact, the best way to use that webcast is print off the beta page for your company, keep it to the side, and as you go through the page, do that for your company as well. In fact, I'm going to use the start of today to kind of review very quickly what we talked about in terms of reading the beta page. And I'm going to use the other companies that I'm going to be following to kind of bring home some points. So last session we talked about looking at Disney, right? We looked at the beta page. We concluded that Disney was riskier than the average stock in the market because its beta was greater than 1. It had done much better than expected during the period of the regression. The Jensen's alpha was positive. The R squared was 73%. Most of the risk in Disney came from the market. Okay? And we used it to kind of get a start on Disney. So today I want to start with Tata Motors, Indian automobile company. Again, I went to Bloomberg. I printed off the beta page. As I said, Bloomberg is very parochial about the way it estimates betas. Because Tata Motors is an Indian company, it runs a regression against the Sensex, which is the Indian equity index. It is not like the S&P 500. It's not got 500 companies. It's got, I think, only 30 companies in it. So it's a narrow index of which Tata Motors is a part. File that away. Reading the regression, the raw beta for Tata Motors is 1.83. For the moment, just file that away. If you're saying that's too high, that's too low, you might be entirely right, but that's what the regression is delivering as a beta. It's much riskier than the average stock. The standard error on the beta is 0.16. So the range with 67% confidence is plus or minus 1 standard error. So 1.83 minus 0.16, 1.83 plus 0.16. With 95% it become 2 standard errors. 69% of the risk in Tata Motors is market risk, and 31% is firm specific. Again, if you diversify, the 31% is going to go away. If I computed an expected return, and I'm going to do it in rupees, so to get the cost of equity in rupees, I'm going to start with a risk-free rate, 6.57%. I know that was way back in time. We forgot how we got it, but basically the way I got it is I start with the Indian government bond rate, which is 8.82%, and I subtracted out the default spread for India, 2.25%, to come up with the risk-free rate. So I go pull that out. That becomes my risk-free rate. The beta is the raw beta, 1.83. The equity risk premium for Tata Motors is the weighted average of where Tata Motors does business, not the Indian risk premium, because it gets a big chunk of its revenues from Europe and from China, so that factors in it. My cost of equity in rupee terms is 19.73%. You're saying that's really high. If you pick a high inflation currency, you will get a high discount rate. That's neither here nor there. Okay? If I had done this entire analysis in US dollars, I'd have got a lower cost of equity. And if I'd done it in Swiss francs, an even lower cost of equity. But the high inflation feeds into your discount rate. One final point. When I did my Jensen's alpha by taking the intercept, and the reason I want you to be careful with that Bloomberg beta page is Bloomberg is incredibly sloppy about going between percentages and decimals. Their intercept, 2.28, is already a percent. Whereas the R squared, 0.83 is 83%. So don't ask me why they do it. It drives me crazy. I've talked to, but they don't seem to care. So just be careful. The intercept is already in percent. You subtract out the risk-free rate, and the risk-free rate I'm going to use, because I'm looking backwards at short-term investments, is a short-term Indian risk-free rate. Not the risk-free rate today, but the rate that prevailed over the 5 years. So 4% I've converted to monthly because my returns are monthly. The Jensen's alpha I get is 35.4%. At some point in this class, you're going to come up with a number like that for your company. And it's going to be just a number. What I'd like you to then ask is, what did this company do? Or what happened to cause this number? So let's take Tata Motors. You have this huge Jensen's alpha, right? 35.4% more than expected every year for the last 5 years. What do you think Tata Motors did during this period? First, how do we rule out that it wasn't a sector-wide phenomenon? You can look at other auto companies in India and see what their Jensen's alpha is, right? It can't be because the Indian market went up a lot, because this is already market adjusted. So you can't say the market was... So it must have been something that Tata Motors did, right? For those of you not familiar with Tata Motors, this is not a fair question. But with anybody familiar with Tata Motors, they did two big things during this 5-year period, one of which worked out really well and one of which worked out really badly. And obviously the one that worked out really well overwhelmed the one that worked out very badly. What is it? First is they acquired Land Rover Jaguar. Do you know who they acquired it from? Ford. If you're going to buy a company, buy it from somebody who's desperate to get rid of it at any cost. I'm serious. Because what Ford had reached the end of the tether. It said, we'll sell Land Rover Jaguar at any cost. So they got Land Rover Jaguar at a bargain basement price. And it's proved incredibly successful. What is the other big thing they announced during this period? The cheapest car in the world. A car so cheap even Indians refuse to drive it. A car where everything is optional. Wheels, who needs some? You need an engine, why not a Bullock in the front? All kinds of stuff. But it's clearly not done well because they clearly misgauged, or they really didn't gauge the market well. But the Jaguar Land Rover acquisition has proved incredibly successful. And that's the Jensen's alpha. And that's what I want you to think about with your company, because when you look at the Jensen's alpha, it's just a number. I want to start asking, why did my company deliver the number it did? And by the time you get to this stage, you will have learned enough about your company. So what I'm saying is, read as many stories as you want about your company, but have a focus. When you look at those stories, ask, where are these stories going to go? And the Jensen's alpha is the end product of something the company did or something the sector did. Those of you working with oil companies right now, when you do your Jensen's alpha as of now, you are going to get a negative Jensen's alpha. And there the answer is going to be easy. It's because oil prices went down. But if you did Petrobras, it's not just the oil prices going down, but you got layers of other stuff. So don't just stop at the sector-wide phenomenon and ask, is there anything else about this company I should be bringing into this process? Any questions about reading the beta page? So let me try a second. I took Vale. Now Vale, I initially looked at the Brazilian listing, and parochial as Bloomberg is, it ran the regression against the S&P 500. I'm sorry, against the Bovespa, which is the Brazilian equity index. But Vale also has an ADR, and some of you are running into this issue because if you have an ADR and you look up the beta for the ADR is actually a listing in the US. It's traded in dollars. It's a dollar-based listing traded in the US. Bloomberg runs a beta against the S&P 500. So in fact, here I have two different regressions for Vale, one against the local index, one against the S&P 500. And the numbers are very different. Based upon the Bovespa regression, my beta is 0.89. But based upon the S&P 500 regression, it's 1.37. I know a lot of equity analysts in Latin America who use the ADR beta because they say they don't trust the beta against the local index. And they're right, but I'll add to that. I don't trust the beta against the S&P 500 either. These are both crappy regressions. So if you ask me which beta should I use, my answer is neither, which leaves you in a bad spot. But we'll fill that in today because obviously this is a problem across regression betas. That is, even if you run the regression beta against a good index, and especially against a good index, your R squared is going to decrease, your standard errors are going to go up. So you get two different regressions. For your project though, pick one and do your beta diagnostics with it. You're asking a specific question and answering it. When I pick the Bovespa regression, the question I'm asking is, relative to the Bovespa, did Vale do well or badly? When I pick the S&P 500, I'm asking a different question. So it's entirely possible I could get two different diagnostics. And you might want to do both just to see how your stock measures up to a domestic investor who cares only about the domestic index and a global investor who measures it up against a global index. Okay? And finally, for Deutsche, I ran the regression. Initially, it ran it against DAX. Why? It's a German company. One of the nice things about the Bloomberg is I can go in and change the index. I changed the index to the FTSE Euro 100, which is 100 large market cap stocks across Europe. My argument being that Deutsche is a German company, but increasingly European investors invest across markets, so maybe I should measure the beta against the few. The betas again are very different. The R squared, not surprisingly, goes down. Do you see why it's going to tend to go down as you broaden the index? Because more and more of your risk is going to become firm specific if you look at a broader index. Very different numbers. And finally, for Baidu, I tried the S&P 500 because it is actually listed in the US. And I ran it against the NASDAQ, which is the index it's listed on. I might get a much better R squared against the NASDAQ, but that doesn't mean the NASDAQ regression is better. In fact, as a general rule, do not use the old statistics rule, which is higher the R squared, the better the regression. Because the R squareds on a regression can be very deceptive. The regressions with the highest R squareds can be the least reliable measures of beta. And I'll tell you the story of one company to bring this home. In early 2000, I ran a regression for Nokia. I actually didn't run the regression. I went to Bloomberg and looked up the beta for Nokia, and I got the best looking beta page I've ever seen. Every point was on the line. The R squared was 94%. The standard error was close to 0. Impressive, right? If that were a statistics class, I could have exhibit 1. Look how good this regression is. And then I took a look at the index. You know what it said? It said the hex. I'd never heard of the hex. I thought it was a witch's curse until I ran the regression. But the hex is actually the Helsinki exchange. You're saying, what the heck are you doing going to Helsinki to run a regression? You know why Bloomberg went to Helsinki, right? Nokia is a Finnish company, and the Helsinki exchange is the Finnish index. Now, I'll make a confession. I had no idea what was in the hex in early 2000, so I went and took a look, and I wish I hadn't. Because it turned out that Nokia was 80% of the hex. So in early 2000, here's what the regression was telling me. If you regress Nokia against Nokia, the two move together an awful lot of the time. In fact, how could you get anything different? In fact, if you take Gazprom and you run a regression against a Russian index, you get exactly the same phenomenon. This is not uncommon when you have a big market cap company dominating an index. And that beta for Nokia was completely meaningless, and here's why. What does beta measure? The risk added to the portfolio of the marginal investors in your company, right? Now, can I find out who the marginal investors in Nokia are? What did I do when I wanted to find out who the marginal investors in Disney were? I printed off the top 17 stockholders. I did that for Nokia. And right on top of the list in early 2000 was Barclays. And it held Nokia as part of their global index fund. That's a red flag right there, because if you're Barclays and you're the marginal investor in Nokia, you're not measuring risk added to the Helsinki exchange. You're measuring risk added to a global equity index, the MSCI, some kind of global index. And increasingly, that's the world we're looking at, is if you look at large market cap companies, I don't care where that company is traded. It could be Ecopetrol in Colombia. It could be Vale in Brazil. It could be Infosys in India. Increasingly, the investors setting prices of the margin are not domestic investors who are constrained to stay in that index. They're global investors pricing it. And that, don't underestimate the impact of that foreign money. Even if it's only 15% of the total money in a market, it can cause huge shifts in prices because at the margin it's concentrated in 10 or 15 or 20 big companies. So is everybody clear? If you're ever asked, well, how do I decide what index to use in a regression, the answer should be a straightforward one, which is the index should depend on who the marginal investors in this company are. If they're global investors, the index should really be a global index. And when you run the regression, don't trust the beta, which kind of undercuts the whole setup to the process. But that's the bottom line when you look at a single regression beta. So here's what I'd like to do. I started this process telling you that betas came from a service, Bloomberg bar, and that's the interaction most of us have with betas. We look it up on somewhere. Then we dug a little deeper and said, no, betas don't come from a service, they come from a regression. Regression of returns on the stock against returns on a market index. But now I'm going to dig a little deeper. I'm going to argue that betas might be estimated using a regression, but they don't come from a regression. They come from choices you make as a business. And to understand what those choices are and how they play out in beta, I'm first going to repeat the definition of beta. Beta measures how you move with the market. It's not a measure of overall variance. It's a measure of how you move with the market. Okay? And what I'd like to do to introduce this part of the discussion is I'm going to list out betas for 7 companies, and this is from way back in time. Some might not even be in existence. And with each one, I'm going to try to tell you a story about why this company has the beta that it does. And in the process, maybe we'll start to figure out what the drivers of betas are. So let me start at the top. Bulgari, beta of 2.45. What does Bulgari do? Make a lot of stuff that nobody needs, was incredibly expensive. Hugely discretionary products, luxury products. You know why its beta is high? Because it's a very discretionary product. In good times, people buy a lot of Bulgaris, I guess. In bad times, they find out that they can live without that Bulgari. It's kind of tough. Okay? So what drives its beta is not some strange factor. It's a fact that they produce a good or service that is incredibly discretionary. File that away. That's the first thing that drives your beta is what do you do as a company? What kind of products or services do you provide? Let me go down. Quest Communications, telecom company. Now, telecom companies fundamentally, at least in developed markets, provide a service that is not that discretionary, right? In fact, here's a very simple test. How many of you can live without your cell phones for the next month? The honest answer is if you didn't have your cell phone, you wouldn't even know where you lived. Because it's recorded there, right? Where do I live? What train do I take? I mean, let's face it, your whole life is... So if you ever break your cell phone, you're dead. I mean, that's it. You're lost, right? So it's fundamentally the business is not that discretionary, but there are 2 things that add on top of that business that makes their betas for telecom companies high. The first is telecom companies tend to have a lot of fixed costs. You see why that matters? Even small changes in revenues are going to translate into big changes in operating income. We call that operating leverage. So that's the first factor. Now, if you have a lot of fixed costs as a company, it's probably not a great idea to borrow money on top of those fixed costs, right? But telecom companies, for some incredibly strange reason, feel this urge to borrow money on top of their fixed costs, which adds another fixed cost, which is interest expenses. Okay? In fact, this might be a good point, ask, why do they do this? Because if you think about telecom companies, and you think about a business that is high fixed cost, you're saying, why would you borrow money on top of those fixed costs if you already have a lot of fixed costs? And you know what the telecom companies will tell you? Because that's how AT&T did it 100 years ago. And AT&T did borrow money to build a lot of infrastructure, but you know why AT&T was able to get away with it? What were they building into? A monopoly. They could charge cost plus. If you're building into a monopoly, a toll road where you're guaranteed that no other roads will be built around the name, you can borrow money on top of fixed costs because you can pass it through. What telecom company today can tell you that they're building into a monopoly? But that's what we talked about, the power of inertia in corporate finance. Companies do what companies 100 years ago did. And they don't even think about the changes the world has gone through before they do it. We'll come back and talk about the airlines, another business that thinks it's 1975 still. No, seriously, these companies are run as if it's pre-deregulation, which is 1977. Strange way to run businesses, and then they wonder why things keep blowing up. It's a definition of insanity to keep doing the same thing over and over and expecting a different outcome. So Quest Communications has a high beta because it has lots of fixed costs and it's borrowed money. So what business are you in? What's your fixed costs look like? How much have you borrowed? Already we're starting to nail down some questions you might need to ask a company. Microsoft, beta 1.25. I've tracked Microsoft every year since 1986, which is the year of their IPO. When Microsoft first went public, their beta was about 2.5. They're a small, risky company. Clearly, they're not the small, risky company anymore. So let's think of what's changed and why it affects your beta. One is they've become a much larger company. By itself, that doesn't affect your beta. But the way they've become larger is they've expanded their product offerings. In 1986, all they had was MS-DOS. They didn't even have Office or any of the other stuff. It was the operating system for a computer. They have more products. They serve a much broader market. That's going to push your beta down. The second is, as they've gotten larger, they've also accumulated a fair amount of cash. You're saying, why would that affect my beta? What's the beta of cash? It's zero. So basically, when you have a lot of cash as a company, that's going to act like basically pull your beta down, because that beta of zero is now part of your company. So you can see why betas move down. And this is the rationale that Bloomberg uses for adjusting betas towards 1. They say, this is what happens in most companies. Look at Microsoft. GE beta 1.15. What business is GE in? Actually, the question to ask is, what business is it not in, right? It's in 26 different businesses. It's a classic conglomerate. What should happen to your beta as a company as you become a conglomerate? It should move towards 1. You see why? Because the average beta for the market is, so as you start spreading out, you're becoming like a mutual fund, your beta should move towards 1. GE's beta stays a little above 1 consistently, because what's the single biggest piece of GE as a company? GE Capital. And what does GE Capital bring into the equation that affects the beta? GE Capital by itself is not risky, but it's funded with GE Capital alone carries $150 billion in debt. That comes into the company. It acts as a ballast, pushing up the beta. I'm not saying it's good or bad, but that's how it affects the beta. ExxonMobil, beta of 0.70. You take an oil company, what's the biggest source of risk that it faces? Especially a company like ExxonMobil. Oil prices. You're saying, but it's a risky company. How come the beta is so low? What does beta measure? Beta measures the risk added to a market portfolio, to a diversified portfolio. If your biggest source of risk is oil prices going down, and the rest of the market potentially could benefit from lower oil prices, not only could you have a low beta, you could even have a negative beta, right? It doesn't happen with oil, because oil, if it drops enough, creates these macroeconomic consequences. But it could happen with a commodity like gold. Your beta could be negative. And that's kind of mind-boggling. This is a classic interview question that you can ask other people. So I'm going to give away the answer, because it's always a good idea to know what the answer of a question is before you ask the question. Okay? First, can the beta of a stock be negative? Of course. But think about the consequence. If you have a negative beta, what does your expected return look like? Risk-free rate plus beta times equity risk premium. If your beta is less than 0, your expected return is going to be less than the risk-free rate. You're saying, that is absurd. Why would I invest in a stock and settle for less than the risk-free rate? What does a negative beta stock buy you? What does it get you? Insurance. That's exactly what it is. It's insurance against some macroeconomic risk. Let's say gold is a specific example. Historically, what has gold been an insurance against? Inflation. I gave away the answer. There you go. You know? Sometimes I jump the gun. It's been historically insurance against inflation. And if the bulk of your wealth is tied up in financial assets, stocks and bonds, adding gold to your portfolio could actually make your portfolio less risky. It's not a question of added risk, it actually reduces risk. You're buying insurance. Keyword is buying. So how do I make you pay? I ask you to settle for a return lower than the risk-free rate. Many of you have gold bugs as friends. These are guys who are invested in gold all the time, every single dollar, and they're convinced the whole world is a conspiracy. They say, it's so unfair. I've been invested in gold for the last 42 years and I've made only 2.5% a year and I took all this risk. To which your response is, you took the wrong kind of risk, because if you put all your money in gold, you are exposed to a lot of risk, but guess what? You're not going to get rewarded for most of that risk because you chose to get exposed to risk you should not have. Gold is a perfectly appropriate investment as an added investment to a portfolio with a lot of financial assets. So if you have $10 million invested in financial assets and you say, I'm going to put $500,000 in gold because I'm really worried about inflation coming back, I think you're on perfectly solid ground. But if you sell the $10 million in stock and you put $10.5 million into gold, you deserve exactly what's coming to you, and it's not going to be good. You might have those moments in the sun, right, when gold prices shoot up, but gold as an investment in the long term, as a standalone investment, is going to deliver horrible returns. Which leaves me with one final beta. Altria, or they used to be called Philip Morris, beta 0.60. You're saying, but there's a lot of risk in tobacco companies. What's the risk we tend to think about in tobacco companies? What's the biggest risk you worry about? Regulation and legal costs, right? Really, legal costs more than regulation, because regulation actually is, once you have the cost, you know what it is, you can build it in, you can build around it. But legal costs are almost a wild card. You're saying, why isn't the beta higher? Why isn't the beta reflecting the cost that you might lose a lawsuit? What kind of risk does beta measure? Risk you cannot diversify away, which is risk that affects most or all companies. I've kind of given away the answer, right? Philip Morris loses a lawsuit. The jury says they have to pay $8 billion. Who's affected? Philip Morris. There's no, it's not like Apple wakes up selling less iPods because that happened. It's classic firm-specific risk. And what I'm setting you up is, when you look at your company and you say, it's a risky company, how come my beta is so low? Take a look at the risk that worries you. You have a biotechnology company. What's your biggest risk that you worry about? That your drugs might not get through the FDA approval process, which has nothing to do with the market. Do not expect a biotechnology company to have a stratospheric beta, because beta was not designed to carry that kind of risk. So you ready? Here's what I'm going to do. I'm going to take the stories I've spun for these companies and try to pull them together, because there are only 3 choices you make, or 3 big decisions you make as a company that affect your beta. Here's the first one. You tell me what you do as a company, the product or service you provide. I can actually guess what kind of beta you should have as a company. And remember what I said, betas measure how you move with the markets. I'll give you the old distinction I used to use. If you're a cyclical company, what's a cyclical company? It's a company that moves with the economy. I would expect you to have a higher beta than if you're a non-cyclical company. Examples of cyclical companies would be companies like housing and automobiles and steel. Non-cyclical companies might be food processing. So that used to be the distinction I drew until about 2 decades ago. I said, cyclical companies, high betas, non-cyclical companies, low betas. But then if I asked you, is Google a cyclical company? You see that in the old smokestack America, it was easy to classify cyclical versus non-cyclical. It's become much more difficult as products and services become fuzzier. So I'm going to give you my second distinction. The more discretionary your product or service is to your customers, the higher your beta will be as a company. And what I mean by more discretionary, if your customers can live without your product, they can delay buying it or defer buying it, you will have a higher beta than if they cannot do that. I'll give you two little experiments you can run on your own to kind of get this concept nailed down. The first is put yourself at the kitchen table of the average family as they're making a list of what they're going to buy this month with their income. You ready? Let's put ourselves at the kitchen table. The family's listing the things they're going to buy in order of priority. So what's on top of the list? Food. Then you have rent and diapers. It's kind of nasty with kids walking around, you know, not toilet trained. And then you start adding things you will buy if you get the money. Like what? A vacation in the Caribbean. And you keep going. My own island in the Caribbean, a butler, a Ferrari Testarossa. You know you'll never get down that far down the list, but it's so much fun making the list. You've listened to too many of those New York lottery ads. Have you seen these? The guy wins and he does all kinds of crazy things. You make the list. Once you have the list, here's what I'd like you to do. I'd like you to look at that list, and that's going to give you an indication as to what kind of beta company will have. So I'm going to throw the names of companies at you. And I'd like you to think about that list and think about where the company goes and tell me what kind of beta you'd expect the company to have. You ready? Kroger's. What does Kroger's do? Grocery stores. High beta, low beta? Low beta. Whole Foods. The eggplant costs 4 times more, but it's organic. So when you're doing really well, you go the organic route, but if you don't do that well, you say, look, an inorganic eggplant, I can live with that. So even within the same business, you can see that the beta will be higher for Whole Foods and Sprouts than it will be for Kroger's and Safeway. How about Coca-Cola? Admit it, you have to get really desperate to go down the generic cola aisle in the grocery store, right? You don't want to admit to it, oh, generic cola, I hope nobody's seeing me. Brand name plus low prices kind of make the beta. How about the New York Times? Where do they make the money? I don't know, they don't make money actually, so let's hypothesize. Where do they get their revenues? Let's forget about the income part. Subscription revenues and advertising. The subscription revenues are actually remarkably stable. You know why? Because people don't want to send the wrong message to their neighbors. You've lost your job, you don't cancel the New York Times because then everybody knows you've lost your job. So it lands in that blue packet day after day after day. You just throw it into recycling. Say, look, I'm getting the New York Times, I must be doing well. Get the Wall Street Journal as well, because then it'll mean people think you actually have money to invest or something when you don't. So the subscription revenues are pretty stable, but that's only 30% of their revenues. The remaining 70% is advertising, which tends to be... did you get the New York Times this weekend? I think it was last weekend, where there was this magazine that I could not even pick up. It was like 400 pages. The economy is doing well. In fact, you can tell how the economy is doing by just picking up the paper. If you have trouble picking up the paper, you have section after section, the economy is doing well. If you pick up the paper, did I pick up the paper? It's so light, you can't even tell whether you picked up the paper. You know that times are not that good. So New York Times will tend to have a higher beta. How about Philip Morris? Here's a very good test of what kind of beta Philip Morris should have. Walk through New York City today. Pretty awful day, right? What's the wind chill outside still, like 20 degrees? What do you see outside every building? Huddled masses of people. Smoking suggests you're enjoying yourself, but what you're doing is you're sucking up the nicotine and said, please, please, let me last an hour before I come back down again. If you want to make the beta for your company really low, make your product or service an addiction. Hey, come on, don't pick on Philip Morris. If Credit Suisse could addict people to structured products, would they in a second? Of course. This becomes the name of the game. If you're a company, you want to get your consumers, your clients addicted to your product so they have to keep coming back. You just don't like it that Philip Morris succeeded and you did not, so you dump on them. Well, don't confuse cause and effect. Why can't they have, did everybody get the question? Philip Morris has large and stable dividends. How come that's not entering in the equation? Let's step back. No, but wait. Why is Philip Morris able to pay large and stable dividends? Because they have large and stable earnings. Why do they have large and stable earnings? Because we smoke, whether it's a recession or a recovery. So when you observe the dividends, you're observing a dividend that is really the end product. It's part of the equation, but it's being driven by a fundamental that's much deeper than what you observe as dividends. You know, the companies you should watch out for is risky companies that pay a stable dividend, but you know how they end up paying a stable dividend? They borrow money, they issue equity. Those companies are not safe. They're actually even riskier than companies that don't pay a dividend because they're sustaining a dividend they should not be sustaining. Well, any bank right now has this problem, right? Because they're stuck on this. We paid dividends for 107 years in a row, which is a very dangerous place to be. So we will continue to pay it. So collectively, there is a whole segments of the market where they shouldn't be paying dividends, but they continue to do so because that's what they've always done. Another example of inertia. So everybody clear with that example? So put yourself at the kitchen table of the average family. You can make it the average Latin American family, the average European family, and maybe items will have lower betas in some regions and higher in others, okay? Depending on what part of the world you're in. Here's your second exercise. And do it this weekend because I think it's supposed to be nicer. So here's what I'd like you to do. Walk over to 8th Street and take the N or the R uptown. Okay? You know how to get to the 8th Street thing. Go uptown. Get off at 60th and 5th. Get out of the subway station. I want to be specific. I don't want you wandering around the station. What did he want us to do? Okay? And here's what I'd like you to do. I'd like you to walk downtown on 5th Avenue. And as you walk downtown, I'd like you to stop in front of every business front that you see and very loudly ask the question, if that business were traded, what kind of beta would I expect it to have? You're saying, why loudly? People will think you're crazy, and that's a good thing. Tourists will cross the street to avoid you. Crazy New Yorker coming at me, yelling something about betas. I have no idea what he's talking about. Let's get out of his way. So you ready? We're going for an unimpeded walk on the stretch of 5th Avenue that everybody is. So starting at 60th, walking downtown. Let's go for a virtual walk. What's the first business I pass? Apple. Let's keep going because it's too close to my non-discretionary items. But right next to FAO Schwartz, I keep giving away the answers today. I don't know what's going on. Right next to Apple used to be FAO Schwartz. It's closed down since closed down last year. But if that were public, is it open again? Yeah. It opened. Okay, it's back being open because they had announced they were going to close down. If that were traded, high beta or low beta? Depends on who's making the list. My oldest son is 25 now, and when he was 8, around his birthday, I brought him into the city. Euphemistically, we used to call it coming in with dad to work. So here's what had happened. You take the train in with a lot of ceremony. He'd have to prepare. He'd have to wear his baseball. We're not going to a baseball game, Ryan. No, it doesn't matter. I have to be dressed right. Okay? So we'd come into the city. We'd go to a baseball card store. We'd have a snack. We'd go to a toy store. We'd have another snack. Snacks were big. Every other store, you'd have a snack. And after about the 4th store, he said, Dad, I want to go home. So what about work, Ryan? He said, I don't care about your work, Dad. The truth would come out sooner or later. But this was around his birthday. I took him into FAO Schwartz. And there was a Ferrari on sale for $8,000. Cheap, right? It's one of those miniaturized Ferraris for an 8-year-old who's everything. I still remember what my son said. He said, Dad, if I don't have that, I will die. I said, I don't think so, Ryan. Let's walk around. If you're on the verge of death, I'll drag you back in here and get it. No? But 17 years later, he seems to be okay. A lot more discretionary than he made it out to be, right? So high beta. Let's cross the street, look both ways. It's 59, very busy. And you're now in what I call the French-Italian section of town. Gucci, Ferragamo, high beta, high beta, high beta, high beta. I've heard you get charged as you walk by the window, so hold on to your credit card, cover it up, do whatever you need to do, and keep walking. Then you get to Rockefeller Center, the betas start, you pass St. Pat's, don't ask, high beta, low beta, lightning might strike you down. But then you get past Rockefeller Center, the betas start to fade a little bit. Not as much as they used to, but there used to be an amazing number of Dwayne Reeds. It's almost like they were trying to get you on both sides of the street. And then you got to the New York Public Library. Betas used to hit rock bottom, 42nd Street. That stretch between 42nd and 34th. Used to be full of stores with brown paper in the window, shady-looking character in the door saying, come on in. Come on in, cheap, cheap, cheap what? Just come on in. You see tourists going in, and not coming out, a different kind of risk, I guess. But you make it all the way down to 34th and 5th. There's a guy who sells umbrellas only when it rains. If you don't believe me, try this out. Wait for a rain. Go to I don't know where he comes from. I think he pops out of the ground. Umbrella. $12, cheap little piece of crap. It breaks up, the first rain that comes up. But if you have a laptop on your back and there's rain coming down, what could be more non-discretionary than an umbrella in New York City, right? That guy ever figured out a way to incorporate and trade, he'd have a really low beta. What I want you to think about before you look at your regression beta page, and do it before you look at the regression beta page, it might already be too late for some of you, is think about your company. Think about the products or services it provides. Think about what kind of beta you should expect to see. So if you're looking at Tiffany's, what kind of beta should you expect to see? Yeah, you go out into that store, there isn't a single item there that anybody's ever needed, right? I remember we got a Tiffany's bowl once for something, I don't know. We never use it, because what the heck are you going to do? You put something in it, the kids knock it over, you're going to kill them. $300 bowl that you can't use. So if you see a Tiffany's regression beta that says the beta is 0.6, do not believe the regression. In other words, you need to have the ammunition say that beta doesn't make sense to me given what I know about the company. Discretionary, non-discretionary. Econ 101, we had a different name for it, right? What do we call it? How do we measure discretionary and non-discretionary? Elasticity. I told you every class you've ever taken in your life is in service of this class. So check off Econ 101. Done your job, leave now, right? Elasticity of demand. If you have a product or service with a very elastic demand, you'd expect it to have a high beta. That's the first step. So here's a simple follow-up test, and you can kind of address this by thinking about what we talked about. If you look at telecom services, for the most part, I said in developed markets, telecom services tend to be non-discretionary. Everybody has a phone, most people have cell phones, so. And you don't cut back on those costs unless you get really desperate. But in many emerging markets, telecom service is still very discretionary. They're growing a lot because as these countries get more prosperous, more people can afford it. So file that away. Let's assume you're comparing the betas for emerging market telecom companies and developed market telecom companies. Given what I just said about discretionary, non-discretionary, you can already see what's coming down the pike, right? If phone service is more discretionary in emerging markets than it is in developed markets, what should you expect to see of the betas for emerging market telecom companies? They should be higher than the betas for developed market. I'm laying a foundation for something else we'll need this later in practical terms, but file that away. Just because you're in a business doesn't mean the beta is going to be the same for that business across the world, because a product or service can be discretionary in some parts of the world and not discretionary in other parts of the world. So that's the first stop, product or service. Any questions about that? Yes?
Can you apply the same reasoning in a company that's primarily a B2B company?
Yeah, absolutely. If it's a business-to-business company, then the question is the product or service you're providing a discretionary product or service to the business you sell it? It's absolutely the same phenomenon, right? So it's the same rationale. You can put yourself at not the kitchen table, but the office table of a business as it makes choices then and see where your product or service falls. Second stop in this game. Look at your fixed cost structure. Call this operating leverage. Basically, you look at the percentage of your costs that are fixed costs, and the higher the proportion of your costs that are fixed costs, the higher your beta. The rationale being, if you have a lot of fixed costs, in good times you make a lot of money, in bad times you lose a lot of money. So if you're in a sector with a lot of fixed cost, I would expect you to have a high beta. So can you give me an example or examples of sectors with a lot of fixed costs? Airlines. Let's take airlines. There are other sectors as well, big infrastructure companies, toll road companies, in general, big infrastructure companies. Think about the cost structure for a typical airline. What's the biggest single expense? You've got to first get, the fuel and would be up there, but you've got to lease the aircraft. Fixed cost or variable cost? It's going to be fixed. Once you lease those aircraft from GE Capital, you can't go to them and say, look, our planes are only half full. Can I pay you half the lease? Fixed cost. Fuel cost, fixed cost or variable cost? Once a schedule is set, it kind of becomes fixed, right? Though United keeps sending me cancellation notices, which I'm getting very suspicious about because I think they just cancel a flight if there aren't enough people on it. Aircraft problems. But assuming you're an ethical airline, which might be an oxymoron, fuel costs are pretty fixed as well. Can you imagine a pilot coming out and starting to count people on the plane? 1, 2, 3, 4. Only 6 people on the plane. Fill it up halfway. Let's see how far we get. There wouldn't be 6 people left on the plane after that, right? So if you're flying New York to LA, you need a pretty full tank of gas. So fuel costs pretty fixed. Employee expenses, if you unionized airline, end up becoming fixed because I've been on flights where the number of stewardesses exceeds the number of passengers. And I can tell you the service doesn't improve any. So I don't think this has anything to do with that numbers, but it's fixed costs. So airlines have lots of fixed costs, very little variable costs. Have you noticed the airlines never have a normal year? They're either going bankrupt or they're making billions. Like watching a manic depressive in action, right? You're either doing brilliantly or you're on the verge of going under. That's exactly what you should expect with a lot of fixed costs. But even within a business like airlines, where the fixed cost structure is overwhelming, there's the outlier, right? The outlier that more cases have been written about than any other company, which is Southwest. Now I know in other classes Southwest is used for other purposes. I'm going to use it for a very specific purpose, to talk about fixed costs and how Southwest deals with fixed costs. First, they lease their aircraft like everybody else. But until very recently, if you took a Southwest flight, what type of aircraft did you sit in? Every single aircraft was a Boeing 737. And the reason they did it was very specific. Each aircraft is unique enough it needs its own maintenance crew. They said, no, we're going to have one type of aircraft, reduce our fixed costs by doing it. It was deliberate. Fuel costs, I hope they don't economize because I sometimes take Southwest. But they're one of 2 airlines that consistently hedges. Singapore and Southwest hedge all of the time. You're saying, what about the other airlines? They hedge at all the wrong times. You know when they start hedging? When oil prices hit 120. You know when they stop hedging? When oil prices hit 40. If you're going to hedge, either do it or don't do it. Don't let the CFO time oil price hedging because he will screw it up. I guarantee you this. So they hedge all the time. Employee expenses, Southwest is unionized. That surprises people. But it's got the most flexible work rules of any airline. It's the only airline where a stewardess has checked me on. Has that ever happened to you with United? You could be surrounded by stewardesses. No, they're checking their job descriptions. No. I don't see checking in as one of my job requirements. I've been here only 38 years. I'm not going to start now. That allows them to kind of fill in spaces. And finally, here's, I think, the saving that most of us miss. Until very recently, if you took a Southwest flight out of the New York area, you know what airport you flew out of? It wasn't LaGuardia, it wasn't Newark, it wasn't JFK, it was Islip. I remember the first time I took a Southwest flight. It said the New York area. I didn't realize how big the New York area was. I don't mean this as an insult to somebody who grew up in Islip. I didn't know where Islip was. I mean, try this. Get into a cab and say, take me to Islip, see what happens. Okay? It's a small town in Long Island, and again, I don't mean to be insulting, but the only reason it's on the map is because Southwest flies out of there. And for the longest time, if you took the New York-LA flight on Southwest, you left Islip Airport in New York. You know which airport in LA you landed? It was Burbank and John Wayne. They've recently added Long Beach, but now they fly to LAX, but they used to fly into Burbank. Have you ever been in John Wayne Airport? It's a great airport, the big statue of John Wayne in the middle. You can walk to your parking. Try it out. It's actually worth it. But you see, why did they do it? You know how you get a gate at one of these major airports? You pay for it. Have you ever flown United out of Terminal C in Newark? Every person has to do it at least once in their life to see what hell looks like. Right? It's got about 150 gates, and here's what happens. They fly into gate 5, and give you a connecting flight at gate 136. I think they do it just for laughs. I'm sure there are people upstairs watching you on TV saying, he's never going to make it. Let's switch the signs on him. It's like a big you see people running like rats in the maze around that place. And United has to pay for every single one of those gates, no matter what. You fly to Heathrow, that's how you reserve the gates. It's a fixed cost you have in good times when you don't mind it, but also in bad times. What I'm trying to say is Southwest has kept its fixed costs low deliberately. It's paid a price for doing so because there were people who did not fly Southwest because it flew out of Iceland. People who did not fly Southwest because it had 737. They wanted the reclining on the 7, whatever it was. But they said that's okay. We're willing to give up some revenues to have lower fixed costs. And the way it paid off was in the start of 2002, right after 9/11. Southwest market cap was greater than the market cap of all of the other airlines put together because the only airline which had the capacity to cut costs as revenue shrunk. So when you're a company, some of this is thrust upon you when you're in a sector, but some of these are choices you can make that affect your cost structure. So one of the things I'd like to know when I look at a company is how much of the costs in this company are fixed and how much are variable. So let's say you open up the income statement for a company. What are you looking for? How much of the costs are fixed and how much are variable? But if you think about how accountants categorize expenses, they don't break expenses down into fixed and variable. They have cost of goods sold, SG&A, and you could try to guess, but you really have no idea. So I'm going to give you maybe a way that might work that will allow you to answer this question. What proportion of the costs in my company are fixed? And I'm going to approach it from a different angle. Remember what I said, if you have lots of fixed costs, small changes in revenues translate into big changes in operating income. Why? Because everything flows through to the bottom line. So what I'm going to do is I'm going to take the percentage change in your operating income and divide it by the percentage change in your revenues. The higher that number, the more fixed costs you have. The problem is if you did this for any 1 year, who knows what you get, right? Strange things can happen in a year. But if I did this over enough years, maybe I can get a sense of, does my company have more fixed costs and less fixed costs than the typical company in my sector? So let me try this. For Disney, I have numbers going back to 1987. For every year, here's what I did. I took the sales and the operating income. I took the percentage change in sales and the percentage change in operating income, and you can see the numbers jump all over the place. But across the entire time period, here's what I get. I get an average change in sales of 11.79% and an average change in operating income of 11.91% over the entire period. If I divide the 11.91 by the 11.79, I get 1.01. File that away because for the moment you're saying, I don't know what that means. Is that high or low? That's what it is for the entire period. Then I redid the analysis starting in 1996. You're saying what? In 1996, Disney bought Cap Cities ABC. So it brought in a very different business into the mix. I wanted to see whether that changed the ratio, and it did. It changed a little bit. It pushed it up to 1.25. So here's where I was at the end of this number crunching. I had a measure of operating leverage for Disney of 1.25. But I'll make a confession. I looked at that number and I had no idea whether it was high or low or average. So I did this for all the entertainment companies, and across all entertainment companies, the number is 1.35. Now, I don't want to build too much of a castle on a single number. But if you trust those two numbers, the average number for all entertainment companies is 1.35, and Disney's is lower than that number, either the 1.01 or the 1.25. What does it tell you first about the fixed cost that Disney has? Less fixed cost than the typical company or more fixed cost? Less. And what's the follow-up to that? Its beta should be lower than the... This case, the difference is too small for you to get carried away. But if you did this for Southwest, the difference is staggering. It's about 1/5 what it is for the entire sector, which is why I would attach a lower beta to Southwest if I was assessing it. Yeah. Interest is a fixed cost, but it's self-inflicted, right? So basically, you can look at the effect of leverage separately. I'm just looking at how much of the business risk, and then we can ask how much financial risk. Because financial risk I can fix, right? I can pay off the debt, I can add to the debt. Business risk comes from the people coming to the... What?
You need money to pay off the debt.
You raise if you're that worried about having too much debt, you might have to raise equity to do it. So if you shut that door off, it'll shift your beta, basically. So I'm separating my risk assessment, how much comes from your business and how much from leverage, because leverage can add to the risk, but it's a separate risk. So that's why we're doing it in 3 steps. We start with what you do, then we look at fixed cost, third step we bring in leverage, because some things might be more controllable than others. Right? So any questions? So basically, fixed costs affect your beta, and if you can get a measure of what that fixed cost is, you might be able to adjust your beta for it. Which brings me to my third and final factor. Yeah.
How much do minority investments or equity investments in other companies affect this?
it doesn't affect the operating income at all. So that's a separate issue, because we're looking at operating income, which measures only income from your operating business. If you're looking at Yahoo, this is just their operating income. So that's a separate issue, because that's, investments you made in other companies. You might be collecting dividends on them and not collecting, but keep that separate until you get to that stage in the process. Third and final factor affecting a beta is how much have you borrowed. Because when you borrow money, you create a fixed cost you did not have until you borrowed the money. The reason I call it self-inflicted is nobody is ever forced to borrow money. You do it because you feel it's in your best interest. You might be wrong in hindsight, but you do it. And it does have consequences. When you borrow money, the beta that I observe for your equity, and this is where your equity investment is going to bear the risk, is going to be higher than it would have been if you hadn't borrowed the money. So I'm going to be a little more specific about the effect of debt on my beta. And then to do this, I'm going to actually define two different betas. And from this point on, you're going to see me use these two betas at different points. The first is what I'm going to call an unlevered beta. Don't ask me why Microsoft Office does this, but it takes a Mac to a PC. It takes all my symbols and puts question marks on them. This is Bill Gates' revenge on me, I guess. But I hope in your notes it's showing up as betas, right? It's okay. So there are two betas I'm going to define. The first I'm going to call an unlevered beta. The unlevered beta is the beta for the business or businesses you're in, reflecting your discretionary, non-discretionary product and the fixed cost. The levered beta is the beta for your equity. You're saying, what's going to separate them? When you borrow money, I'm going to measure how much you borrow with a debt to equity ratio. And I'm going to use market values, because ultimately that's what I care about if I'm looking at beta. So if you borrow $5 of debt for every dollar of equity, your debt to equity ratio is 5. I'm going to give you a bit of a break when you borrow money. Actually, I'm not the one giving you the break. The government gives you a bit of a break when you borrow money by making interest tax deductible. You see how that reduces your burden? You have a fixed cost, but the government says, don't worry, you're paying only 70% of that fixed cost, because the fixed cost is tax deductible. So I'm going to multiply the debt to equity ratio by 1 minus the tax rate. So what I'm effectively doing is I'm taking the unlevered beta, which comes from the first two steps, right? Business you're in and how much your fixed costs are. And I'm going to affect that beta by adding on debt. And what I'm going to end up with is a levered beta for the company. Now earlier when we ran a regression to get a beta, we got a regression beta, right? So I have a question I need to ask that I want to kind of get out of the way. When you run a regression and you get a beta from a regression, like I did for Disney, 1.25, is that regression beta a levered beta or an unlevered beta? It is a levered beta, but how the heck did leverage creep in there? Because all I did was one regression, right? I never looked at debt and equity, so it must have come in indirectly somehow. How did the leverage get in there? What was it a regression between? Returns on the stock against returns in the market index, right? When you borrow money, guess where it shows up? Your stock returns get more volatile. It's very, very happenstance, because you're hoping and praying it happens, but a regression beta is a levered beta. But here's the catch. It reflects the leverage you had during the period of your regression. You think, as opposed to what? Let's say you borrowed $15 billion yesterday. You have a lot of debt, right? But your regression beta has no chance of reflecting it, because I ran the last 2 years of the last 5 years. So regression beta is a levered beta, but the leverage that's imputed in it is the debt to equity ratio you had during the regression period. So here's what I did. I went back and I got the regression beta for Disney, 1.25. The average debt to equity ratio during the period of the regression was 19.44%. So basically I took the last 5 years. And I'm going to do something very strange. I'm going to take that levered beta, 1.25, and I'm going to take out the effect of the debt from that beta. It's called unlevering a beta. And you're going to see in a minute why I want to do this. But I used a 36.1% tax rate. I'll come back and talk about why I used the tax rate for Disney. But I took the levered beta and I cleaned it up by taking out the effect of leverage. I end up with 1.11. Have you ever watched Jeopardy? It's a very strange show. You're given the answer. You got to guess the question. So let's play some Jeopardy. If 1.1119 is the answer, what is the question? Don't ask what's the unlevered beta. I'd like something a little deeper than that. What is the question to which 1.1119 is the answer? Want to try? It's actually the business portion, right? The equity portion is actually higher. So in fact, reframe the question. If I asked you, what is the risk of the business that Disney is in? Not the risk of its stock, but the risk of the businesses that Disney is in. The answer is 1.1119. You know what the other question to which it's the answer of? What did I say about debt? It's a choice you made, right? Could Disney have chosen to have been an all-equity funded company over the last 5 years? Sure. And if they had, what would the beta of the stock have been? 1.1119. So 1.1119 is the answer to two separate questions. What is the risk of the business or businesses your company's in? And you can already see that you can have risky equity in a safe business if you borrow enough money. And the second is, if you've chosen to run this business as an all-equity funded business, what beta would have seen? The answer is 1.1119. You say, why do you even need to know that? Because all you need is a beta for your equity. Here's the reason I need to know this. Can companies change their mind on debt to equity overnight? Bill Ackman comes in and says, or Carl Icahn comes in and says, borrow 5 times as much money. You might, right? In other words, I need to be able to adjust my beta if you change your mind about how much to borrow. If you decide to pay off all your debt or double your debt, I need to be able to tell you what your beta will be, and I think I can do it now if I have this unlevered beta. In fact, here's what I did. I took that unlevered beta and I changed the debt to equity ratio. Because remember, the beta reflects the business you're in. All I'm changing is the mix of debt and equity that used to run the business. From 0% debt to 90% debt, which translates into a 900% debt to equity, right? Which is what a typical LBO is. If I did a leverage buyout of Disney, not a great idea, but if I decide to do it, guess what's going to happen? My beta is going to go to 7.5. That's like building a house on the coast of a Caribbean island where hurricanes come through every 6 months. Which is, if times are good, you're going to be okay. But if a hurricane comes in before you've got the house built, you're sunk. So if you do an LBO, what are you hoping for? That the economy will stay strong enough until you get back to steady state, which is you hope to pay down the debt. But even the best structured leverage buyout is going to blow up if you have a recession or some economic shock come in. Because that's exactly what a beta of 7.5 is. Basically, a recession will feel like a depression to you because everything gets magnified 7.5 times forward. So the next time you read about a leverage buyout, think through the consequences. In fact, here's an interesting follow-up. Remember when Blackstone went public about 4 years ago? It was one of the first PE houses to go public. And when it went public, equity research analysts were dazzled by its return on equity. It's about 22%. They said, look how good the return on equity is. But before you get too excited by the 22%, what's Blackstone's fundamental business? They invest equity in these highly levered transactions, right? And if you invest equity in highly levered transactions, what kind of betas should you be observing? Betas of 4, maybe not 7.5, 4 or 5, which means your required return has to be about 20%. So before you think 20% is great, factor in the reality that these companies have huge amounts of leverage at play, and they need to make 20% just to break even. So maybe a company that makes 11% return equity and borrows no money is a better investment than Blackstone making a 20% return equity, which might be borrowing 70 to 80% of its investment. So those are the three things that come together in your beta. What business are you in? How much are your fixed costs? How much have you borrowed? Question.
How do you think about that if the leverage is operating leverage as opposed to...
If it's operating leverage, the question is, with financial leverage, you have a choice, right? You can pay down the debt, you can choose not to do it. You're saying, what if I'm in a business with a lot of fixed costs? First, please, yeah.
That's not the question.
Okay.
The question was, with the Blackstone example, all the leverage is at the opco level.
No, but remember, they put the debt into the operating company. So you can't blame the operating companies because the way Blackstone and KKR operate is they go into Sealy's and they say, look, you guys don't have enough debt. You need to have it 5 times. So I'm not saying that's not a bad business model, but this is not thrust upon them. That debt at the operating company was put in there by KKR or Blackstone. So the fact that it's in the operating company doesn't separate them from that debt. It's still equity in a highly levered transaction, and the cost of equity has to reflect it. So it's like being in lots of private businesses, because these companies are now private with a lot of debt. And what they're hoping to do, and I'll give you the good case scenario for them, is they're hoping to use a 1.5 or 2 year window where they get the cash flows from this business. They try to pick cash-rich businesses and pay down the debt before the next recession hits or the next shock hits, right? And that's what you worry about if you're a KKR or Blackstone, is what if that happens sooner than that? Yeah.
I guess my point was just the leverage in Blackstone
You won't see it in the balance sheet.
is ring-fenced when you invest in Blackstone equities.
I don't know what you mean by ring fence, because in a sense you won't see it on the balance sheet, but you will feel it, right? And that's, you're right, it won't show up in the debt to equity ratio in any conventional form because it's almost off balance sheet debt, because it's like real estate companies that invest in buildings, in equity in buildings. You might not see any debt on the company, but each of these buildings has 90% debt, 85% debt, 80% debt, and you still feel the consequences as an investor in the company. So here's what I'd like to do. I've kind of dug a grave for a regression beta. I'm going to push it into the grave, but to do that I've got to replace it with a different way of thinking about betas. And to do this, I'm going to draw on a property that betas have that make them very easy to work with. When I first say this, you're going to say, who the heck cares? But you're going to see it's going to have huge consequences. The beta is always a weighted average. A beta of a collection of investments is a weighted average of the betas of the individual investments in that collection. I told you, when I first said this, you know, who cares? Let's say you run Fidelity Magellan, one of the largest mutual funds in the world still, right? It has 150 different companies in the portfolio. And I ask you, what's the beta for Fidelity Magellan? Here's a simple way to get it. Take the betas of the 150 companies, look at how much money you've invested in each one, take a weighted average. You're done. That's true whether you have an investment, 10 assets, 50 assets. So a mutual fund's beta is a weighted average of the beta of the individual companies. In fact, tomorrow's weekly challenge, I'm going to send you the link to the Berkshire Hathaway thing Warren Buffett sent out his 50th annual. And I'm going to send you the 50 years of returns on Berkshire Hathaway, which was in the report with the S&P 500. And I want you to compute the Jensen's alpha and the beta. You know what you're going to find, right? What kind of Jensen's alpha do you think you're going to find over the 50 years? A big positive number. Then you can ask, why did that happen? But I want you to kind of use that as a vehicle to start thinking about betas and Jensen's alphas and what they tell you about a company. But betas are weighted averages. Here's the other place it's going to be even more useful. What did I say GE was in? 26 different businesses, right? What if I could give you the beta of each business? You say, no chance of doing that, but let's say I could. The beta for GE as a company is going to be a weighted average of the betas of the 26 businesses it's in. Or if you have two companies come together in a merger, the Time Warner Comcast merger that's still teetering on the edge of disaster, but let's say those companies come together. The beta of a combined company is always a weighted average of the betas of the individual companies that went into the merger. So that's the last thing I'm actually going to do today, is I'm going to take a merger from a while back and use this. Yeah? All that depends on which direction you came from, right? So if you have lower beta and you become, if you're a conglomerate, your beta will move towards 1, whether it's from below 1 or above 1. But that doesn't really do it. It's still a weighted average, right? The reason it's moving towards 1 is you're adding a low beta and a high beta, the low beta and a high beta. The weighted average is going to push towards 1. But if you're a business that decides to be only in the technology space, and you buy software companies, your beta will never converge on 1. It'll actually converge on a much higher number. So depending on how you go across businesses, you can end up with betas well below 1, around 1, above 1. Conglomerates tend towards 1 because they get across businesses. Okay? So I'm going to go back in time to the 1996 acquisition of Disney and Cap Cities. And I'm going to use this to kind of illustrate the effect of a merger in betas. So here's what the companies look like in 1996. Disney was headed by Michael Eisner then, Cap Cities by Thomas Murphy. Right? Disney had debt of $3.186 billion, market value of equity of $31.1 billion. If I add the debt plus equity, their total value as a company was $31.1 billion. I'm sorry, $34.286 billion, the sum of those two. And their debt to equity ratio was about 10%. So that's what Disney looked like at the time of the merger. Cap Cities had a beta of 0.95, debt of $615 million, equity of $18.5 billion, and a debt to equity ratio of 3%. So two companies, independent companies at the time of the merger. What I'm going to try to figure out is what's going to happen. Disney was acquiring Cap Cities, and so Cap Cities was going to become part of this Disney empire. My question is, what will happen to the beta of Disney after the merger? And I'm going to do this in 2 steps. And if you follow these two steps, you'll be able to handle any acquisition, any M&A that you're ever faced with in terms of coming up with the beta for the combined company. Here's the first thing I'm going to do. I'm going to estimate the unlevered beta for both companies. Remember how I did that for Disney by taking out the effect of debt? And you're going to see why I need to do this in a few minutes, but hang in there. So what I did was I took Disney's beta, unlevered it using the 10% debt to equity ratio that Disney had. I used a 36% tax rate for both companies then. I came up with an unlevered beta for Disney of 1.08. Remind me again what that tells me? That's the beta for Disney's businesses, right? I did the same thing for Cap Cities. I took the levered beta, unlevered it, came up with an unlevered beta of 0.93. I have the unlevered betas for the two businesses. Step 2 in this process is I'm going to take a weighted average of those unlevered betas. Weighted by what? By the values of the two companies. Not the equity values, but the total values of the two companies. The total value of Disney, if you go back to the previous page, debt plus equity, $34,286. And the total value of Cap Cities is 19.115. So those are the weights that I use. The weighted average is 1.026. You know what that tells me? After the merger, the unlevered beta for the combined company is going to be 1.026. Why is it lower than Disney's current unlevered beta? Because you're buying a safer business. If they bought a riskier business, they'd have moved in the other direction. You're saying, why don't you just take the equity betas? What have I not told you yet? Disney is going to acquire Cap Cities, I said, right? I didn't tell you how. Are they going to use debt? Are they going to use equity? Because you can use any number of different choices. So what I'd like to actually do is take you through the process of how the beta will look given different ways in which they could have done the acquisition. Let's do a hypothetical. Let's assume Disney had used all equity to fund this acquisition. Could have done that, right? What does that mean, all equity? What are the ways in which you can use all equity? You can issue shares to the market, come up with the cash and use it. Or you can issue shares directly in a share. So let's suppose they'd used all equity. Here's what the combined company would have looked like in terms of debt to equity after the transaction. Let's also assume that they're going to assume Cap Cities debt. Because often in an acquisition, this is a choice you might face is, do I want to pay off the existing company's debt, if it's at high rate, or do I want to assume it? In this case, let's keep it as an assumed debt. You can change that and see what the effect is. It's not going to be that large. The total debt after the merger will then be $3,186. That's Disney's debt, plus the $615 that they assumed from Cap Cities. The total debt they would have after the merger would be $3.8 billion. So everybody with me so far? Because they didn't take on any debt, all it is the sum of the debts of the two companies. The equity in the combined company will be $31.1 billion plus 18.5 because they have to issue $18.5 billion in new equity to cover the Cap Cities acquisition. My total equity after the transaction would be 49.6. My debt to equity ratio would be 7.66%. I have the unlevered beta, 1.026 from the previous page. I plug in the 7.66%. The levered beta for the combined company after the transaction, if Disney had used all equity, would have been 1.08. So is everybody clear on what I've done? I've come up with the unlevered beta, then I looked at how the transaction was financed to figure out what the debt to equity ratio was. That's not the way how Disney funded this transaction. Here's what they actually did. They borrowed $10 billion and they raised $8.5 billion in new equity to do the transaction. So let's see what the numbers will now look like given what they actually did. 3.186, so if you look at the debt after the transaction, 3.186 plus 615 plus an extra 10 billion, which you've taken on. My debt after the transaction is going to be 13.8 billion. My equity after the transaction will be 31.1 billion plus the 8.5 billion in new equity. What happens to Cap Cities equity after this transaction? You just have a big bonfire. It's gone. There's nothing there. You've replaced it with your choice in funding. My debt to equity ratio is now 34.82%. My levered beta is 1.25. I'm going to leave you with a third choice, and I want you to try to figure out what the beta would be if Disney had done the following. What if Disney had borrowed the entire $18.5 billion to fund this transaction? Work it out. I'll send the answer in an email tomorrow. We know the beta would be higher than 1.25. I want you to work out exactly how much higher. So if they'd funded the entire transaction with If you can do this, you can do any merger, because what you're doing is separating the two steps, right? You're separating the operating risk effect by looking at the unlevered beta. You're separating the financing effect by looking at the levered beta and the debt to equity ratio. I know we're getting close to the end, but let me set up what we're going to do in the next session. I told you I don't trust regression betas, so I'm going to come up with a different way of estimating betas. And to do this, I'm going to look at the beta of a firm as a weighted average of the betas of the different businesses it said. I'll give this a name. I call it a bottom-up beta, but you might have used a different term if you've taken a finance class before. But here's, and we'll end with this. Here's the process I'm going to follow. Let's suppose you're a company, you want me to estimate your beta. I come to you with a question. What business or businesses are you in? It's a pretty straightforward question, right? Let's suppose you give me two businesses, steel and chemicals. Here's what I do. I go find as many publicly traded steel companies as I can and as many publicly traded chemical companies as I can. Why publicly traded? Because I can get a regression beta for each of them. Let's say I find 100 steel companies and 100 chemical companies. I average 100 steel company betas and 100 chemical company betas. I end up with an average regression beta for a steel company and average regression beta for a chemical company. Then I unlever those betas, because the debt to equity ratio for steel companies and chemical companies might be very different than your debt to equity ratio, so I take out the effect of debt just like I did for Disney. I end up with an unlevered beta for a steel company and an unlevered beta for a chemical company. I come back to you. Say, tell me how much value you get from each business, and your reaction might be, I don't know how much value, but I can tell you how much revenues I get. 80% from steel, 20% from chemicals. I take a weighted average of my two unlevered betas. I now have an unlevered beta for you as a company. Last step, I ask you, what's your debt to equity ratio? You give me that number. I plug it in. I have a levered beta. Why am I doing this? Because I don't like regression betas, right? Where did I get the 100 steel company betas? I got them from regressions. All I've done is replace one regression beta with an average of 100. So what's the big deal? What do you say by doing that? Remember the law of large numbers in statistics? I remember when I first heard this, I said, this is a bunch of crap. Because here's what I heard. You can take 100 crappy numbers, you can put them in a pot, you can stir them up, you can get the average out, and the average is magically precise. How the heck does that happen? Until you think about the mechanics. When I say these regression betas are crappy, they're big standard errors. You know what I'm saying, right? Some are overestimated, some are underestimated. When I average out my mistakes. You know how much more precise the average of 100 regression betas is going to be than one regression beta? It's going to be 10 times more precise. And the simple rule is take the square root of the number of companies in your sample. You've just made your beta 10 times more precise by using a bottom-up beta. So what we're going to do on Wednesday is actually take Disney, break it down by businesses, come up with this beta for Disney as a company by looking at the businesses it's in. And that's going to give us a much better sense of what the beta for Disney should be as a company than that single regression that we ran for the company.